Question 8. How sensitive is the ETF's price to changes in interest rates? The iShares Core Global Aggregate Bond UCITS ETF's price has an inverse relationship with interest rates. This means that when interest rates rise, the price of the ETF tends to fall, and vice versa. Here's a deeper explanation of this relationship. Bond prices and interest rates. Bonds essentially represent loans made to governments or corporations. The investor receives periodic interest payments, coupons, and a return of the principal amount at maturity. The price of a bond is determined by the prevailing market interest rates. When market interest rates rise, the value of existing bonds with lower fixed coupon rates becomes less attractive compared to new bonds offering higher interest payments. To compensate for the lower coupon payments, investors are willing to pay a lower price for existing bonds, causing their market value to decline. Impact on the ETF. The iShares Core Global Aggregate Bond UCITS ETF holds a basket of various bonds. As interest rates rise, the individual bond prices within the ETF tend to fall. This decline in the underlying bond prices translates to a decrease in the overall net asset value, NAV, of the ETF, which reflects the per-share value of its holdings. Consequently, the market price of the ETF itself also tends to decrease. Factors affecting interest rate sensitivity. Effective duration. The ETF's effective duration measures the average time it takes for the ETF to receive all its expected cash flows, coupon payments, and principal repayment. A higher duration translates to greater sensitivity to interest rates. The specific duration of the ETF can be found in its fact sheet or prospectus. Maturity profile. The average maturity of the bonds held within the ETF also influences its interest rate sensitivity. Longer maturity bonds are generally more sensitive to interest rate changes compared to shorter maturity bonds. Mitigating interest rate risk. While interest rate movements are inevitable, there are ways to potentially mitigate their impact on the ETF. Investing for the long term. Over extended periods, bond price fluctuations tend to even out, and investors can benefit from holding the ETF until maturity or near maturity of the underlying bonds. Diversification. Including the ETF within a broader portfolio that also holds assets with a positive correlation to interest rates, like certain stocks, can help manage overall portfolio volatility. Question 9. How does the ETF manage duration risk? The iShares Core Global Aggregate Bond UCITS ETF manages duration risk, primarily through the selection of the underlying index it tracks. Here's a breakdown of how this approach works. Understanding duration risk. Duration risk refers to the sensitivity of a bond's price to changes in interest rates. Bonds with longer maturities, time until they mature, are generally more sensitive to interest rate fluctuations compared to shorter maturity bonds. This is because a larger portion of a long-term bond's total return comes from its future cash flows, which become less valuable when interest rates rise. Index selection and implicit duration management. The iShares Core Global Aggregate Bond UCITS ETF typically tracks an index like the Bloomberg Barclays Global Aggregate Total Return Index, BAL-TR. This index construction process inherently manages duration risk to some extent. Market capitalization weighting. The index primarily weights bonds based on their market value. This means bonds with a larger outstanding issue size will have a greater weight in the index. As larger bond issuers tend to be governments and established corporations, they often issue longer-term bonds to raise significant capital. This can lead to the ETF having a somewhat higher average duration compared to an equal-weighted portfolio. Maturity spectrum. The index incorporates bonds with varying maturities, offering a balance between potential income generation and interest rate sensitivity. However, there might be a bias towards some level of duration to capture the yield potential of longer-term bonds while still maintaining some diversification across maturities. Limited control over specific duration. It's important to note that the ETF itself doesn't actively manage duration by selecting individual bonds. The duration of the ETF is primarily a function of the index composition. While the index construction process might inherently introduce some level of duration risk, it also offers diversification across various maturities, potentially mitigating the impact of interest rate changes to some extent. Investor considerations. Investors concerned about duration risk can explore alternative options. Shorter-term bond ETFs. These ETFs focus on bonds with shorter maturities, offering lower sensitivity to interest rates but potentially sacrificing some yield potential. Laddered approach. Investors can build a bond portfolio with a ladder of maturities, holding bonds maturing at various intervals. This approach helps spread out interest rate risk and provides a regular stream of maturing bonds. Question 10. Are there any specific geopolitical risks that could disproportionately affect the ETF? Yes, the iShares Core Global Aggregate Bond UCITS ETF is susceptible to certain geopolitical risks that could disproportionately affect its performance. Here's a breakdown of some key considerations. Global economic downturn. Geopolitical events like wars, trade disputes, or major political instability can trigger global economic downturns. This can lead to rising risk aversion. Investors might flee to safer assets like U.S. Treasuries, causing a sell-off in riskier bonds, potentially including those held within the ETF. This could decrease the ETF's price. Lower interest rates. Central banks might cut interest rates to stimulate economic activity. While this could initially benefit bond prices, it might also signal a weaker economic outlook, potentially leading to lower future returns on the ETF. Currency fluctuations. The ETF offers hedged and unhedged share classes. The unhedged version is directly exposed to fluctuations in foreign exchange rates. Geopolitical events can trigger sharp currency movements, impacting the value of the underlying bonds and potentially leading to unexpected losses or gains for investors in the unhedged share class. Sovereign debt issues. The ETF holds government bonds from various countries. Geopolitical instability or economic mismanagement in specific countries can raise concerns about their ability to repay their debts. This could lead to downgrades in sovereign credit ratings, potentially causing the value of those bonds within the ETF to decline. Regional concentration. While the ETF aims for global diversification, the specific weightings of different countries within the index can influence its vulnerability to geopolitical events. For instance, a larger allocation to bonds from a politically volatile region might amplify the impact of events in that region on the ETF's performance. Examples of geopolitical risks. The ongoing war in Ukraine has disrupted global energy markets and supply chains, leading to inflationary pressures and potentially prompting central banks to raise interest rates. This could negatively impact the ETF's price. Trade tensions between the U.S. and China can create uncertainty in the global economy, potentially leading to risk aversion and impacting the ETF's performance. Mitigating geopolitical risk. Diversifying your portfolio beyond the ETF can help manage geopolitical risk. Consider including assets with a lower correlation to global economic conditions. Investing for the long term can help smooth out short-term fluctuations caused by geopolitical events. Choosing the hedged share class can mitigate the impact of currency fluctuations on the ETF's price. However, hedging itself comes with its own set of risks and costs. Question 11. How does the ETF manage liquidity risk within its holdings? The iShares Core Global Aggregate Bond UCITS ETF manages liquidity risk within its holdings through a combination of the following strategies. Index composition and market capitalization weighting. The ETF primarily tracks an index like the Bloomberg Barclays Global Aggregate Total Return Index, BAL-TR. This index is constructed with a focus on investment-grade bonds issued by governments and established corporations. These issuers typically have a strong credit history and are more likely to have issued large quantities of their bonds, making them more liquid in the secondary market. The index also weights holdings based on market capitalization. This means bonds with a larger outstanding issue size will have a greater weight in the ETF. This weighting approach naturally favors more liquid bonds, as they tend to have larger trading volumes. Diversification across issuers and geographies. The ETF holds a diversified basket of bonds from various countries and issuers. This diversification helps spread liquidity risk. If a particular bond or issuer becomes less liquid, the impact on the overall ETF is mitigated by the presence of other, more liquid holdings. Portfolio rebalancing. The ETF rebalances its portfolio periodically, typically quarterly or semi-annually, to ensure it aligns with the target index. During rebalancing, the ETF manager might consider the liquidity of bonds when buying or selling. They might prioritize trading in more liquid bonds to minimize the impact on the overall portfolio liquidity. Limitations of liquidity management. While the ETF strives to hold liquid bonds, there's no guarantee that all holdings will be perfectly liquid at all times. Market disruptions or unforeseen events can temporarily reduce the liquidity of even investment-grade bonds. The ETF cannot actively trade individual bonds within the portfolio to specifically manage liquidity risk. The holdings are primarily dictated by the target index composition. Question 12. How does the issuer ensure the quality and diversification of the underlying bonds? The quality and diversification of the underlying bonds within the iShares Core Global Aggregate Bond UCITS ETF are primarily ensured through two key mechanisms. 1. Underlying index construction. The ETF tracks a specific index, typically the Bloomberg Barclays Global Aggregate Total Return Index, BAL-TR, or a similar broad market bond index. These indexes are designed to provide diversified exposure to the global investment-grade bond market. The index provider employs a robust methodology for selecting and weighting the bonds within the index. Here are some key aspects of this process. Credit quality focus. The index primarily focuses on investment-grade bonds issued by governments and corporations with strong creditworthiness. These bonds are assigned ratings of BBB or higher by SP or Ba3 or higher by Moody's, indicating a relatively low risk of default. Market capitalization weighting. Bonds are primarily weighted within the index based on their market value. This means bonds issued by larger and more established government and corporate entities tend to have a greater weight in the index. This weighting approach naturally favors more liquid bonds. Maturity diversification. The index incorporates bonds with varying maturities, offering a balance between potential income generation and interest rate sensitivity. While there might be a bias towards longer maturity bonds to capture yield, the index aims to avoid excessive concentration in any specific maturity bucket. Geographic diversification. The index holds bonds issued by governments and corporations from a wide range of developed and emerging markets. This geographic spread helps mitigate risks associated with specific countries or regions. 2. Passive management by the ETF issuer. The iShares Core Global Aggregate Bond UCITS ETF follows a passive management approach. This means the ETF manager doesn't actively select individual bonds within the portfolio. Instead, the ETF aims to replicate the holdings and weightings of the target index as closely as possible. Benefits of this approach: reduced costs. Passive management generally comes with lower expense ratios compared to actively managed bond funds. This translates to potentially higher returns for investors over the long term. Diversification. By tracking a broad market index, the ETF offers instant diversification across various bond issuers, credit qualities, maturities, and geographic regions. Transparency. The index methodology and holdings are publicly available, allowing investors to understand the ETF's underlying exposure. Limitations to consider: tracking error. The ETF might not perfectly replicate the target index due to factors like bid-ask spreads and trading costs. This can lead to a slight tracking error, meaning the ETF's return might deviate somewhat from the index return. Limited control over specific qualities. Investors don't have direct control over the specific credit quality, maturity, or issuer selection within the ETF. This is determined by the underlying index composition. Question 13. Could an individual bond ladder strategy achieve a similar risk-reward profile? Yes, an individual bond ladder strategy could potentially achieve a similar risk-reward profile to the iShares Core Global Aggregate Bond UCITS ETF, but with some key differences to consider. Similarities. Diversification. Both strategies can offer diversification across bonds, with varying maturities. This helps spread out interest rate risk and provides a regular stream of maturing bonds, in the case of the latter. Income generation. Both can provide a steady stream of income from coupon payments. The ETF might offer a slightly more consistent income flow due to its diversified holdings, while a bond ladder can be tailored to provide predictable income at specific intervals. Risk management. Both can be used to manage interest rate risk. The ETF achieves this through its inherent maturity distribution, while a bond ladder allows you to stagger maturities to reduce the impact of interest rate fluctuations on your overall portfolio. Differences. Management complexity. The ETF offers a passive, hands-off approach. A bond ladder requires active management, including selecting individual bonds, monitoring maturities, and reinvesting proceeds. Transaction costs. The ETF typically has a low expense ratio. A bond ladder strategy might incur transaction costs for each individual bond purchase. Precision and control. The ETF provides exposure to a broad range of bonds within the target index. A bond ladder allows for more precise control over maturity dates, credit quality, and potentially higher yields by selecting specific bonds. Potential for higher returns. A well-constructed bond ladder might offer slightly higher potential returns compared to the ETF, especially if you can identify undervalued bonds. However, this also involves taking on more credit risk in your selection process. Question 14. How do these bond investments compare to alternative income-generating assets like REITs or high-dividend stocks? Here's a breakdown of how bond investments, specifically the iShares Core Global Aggregate Bond UCITS ETF, compare to alternative income-generating assets like REITs, real estate investment trusts, and high-dividend stocks. Income generation. Bonds typically offer regular coupon payments that provide a steady stream of income. The iShares Core Global Aggregate Bond UCITS ETF, by design, aims to hold a diversified basket of bonds, offering a consistent, though potentially lower, income stream compared to some alternatives. REITs are required by law to distribute a significant portion, usually around 90%, of their taxable income to shareholders as dividends. This can translate to a higher and potentially more predictable income stream compared to the ETF, especially if the REIT focuses on income-producing properties like apartments or commercial buildings. High-dividend stocks. Companies with a history of paying high dividends can be a source of income for investors. However, these dividends are not guaranteed and can be cut or suspended if the company's profitability declines. The income stream from high-dividend stocks can be less predictable compared to bonds or REITs. Risk and volatility. Bonds are generally considered less volatile than stocks or REITs. However, they are still susceptible to interest rate fluctuations, with prices falling when interest rates rise. The iShares Core Global Aggregate Bond UCITS ETF, due to its diversification, can help mitigate some of this volatility. REITs can be more volatile than bonds, but less volatile than individual stocks. Their performance can be impacted by factors like changes in interest rates, property values, and vacancy rates. High-dividend stocks can be more volatile than both bonds and REITs. Their prices can fluctuate based on the overall stock market performance and the company's specific financial health. Growth potential. Bonds generally offer lower growth potential compared to stocks or REITs. Their primary focus is on providing income through coupon payments and the return of principal upon maturity. REITs can offer some capital appreciation potential along with their dividend income. Property values can increase over time, leading to a rise in the REIT's share price. High-dividend stocks can offer both income and capital appreciation potential. A company's stock price can rise alongside its earnings growth, potentially offering significant long-term returns. Alright, ETF adventurers, that's a wrap on our income investment exploration. So, to recap. Bonds, the chill king of income, offering steady streams of cash with lower volatility. The iShares Core Global Aggregate Bond UCITS ETF is a great example, providing diversified exposure to the global bond market. REITs, think real estate on steroids. REITs dish out a hefty chunk of their income as dividends, potentially offering higher and more predictable payouts than bonds. High-dividend stocks, buckle up for the income roller coaster. These stocks offer juicy dividends, but remember, they can be more volatile and the payouts aren't guaranteed. The best option for you depends on your risk tolerance and goals. Craving stability? Bonds or REITs might be your jam. Can handle some ups and downs for potentially higher rewards? High-dividend stocks could be a good fit. For a deeper dive into each option, check out the links in the description below. Don't forget to like this video and subscribe to Chat ETF for more awesome ETF content. Until next time, happy investing!